Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. You know, I have a great time here doing this, and I love my business, so I love doing what we do, and I don't ever want to do anything else. Just really enjoy it. I'm one of those that'll never retire because I don't have anything more fun to do than that. But one of the things that
say much about your life.
I know, maybe not. Well, it's it's a lot of fun. This is one of those businesses that I love working with people. I love meeting with people. I love helping people, and it's such a fascinating business. There's so many different parts there. There's the tax planning piece, which we're going to get into today. There's investment side of things, the estate planning part, the financial planning itself, of course. How are we going to take all these different parts for each individual and put that into a strategic plan that's going to help you minimize taxes, maximize your returns, minimize risk, attain your goals, being able to attain and maintain your standard of living, quality of life. It's so much fun. And the Social Security rules, the taxes on Social Security, Medicare, healthcare costs are a huge cost in retirement. How to make sure that you can minimize those and understand how those work as far as Medicare as an example, and health insurance in general. So there's so many different pieces and parts that go into this kind of planning, and I truly do enjoy it.
It's a big puzzle.
It is. So I get to go, I go on vacation, I come back, and it's like, woo, this is more fun again.
Well, we have the big tax change. So some of the things that you may have had a plan, in my opinion, I think a lot of times people will go in, make a plan, but they don't really come back and visit it very often, right? So they basically say, oh, I made a plan 10 years ago. Yeah. Well, wait a second. Tax changes, really the beginning of 2018, big changes. We dropped 3%. So maybe if you were in that 15% tax bracket, would you make some changes because maybe now is the time to pay more taxes, keeping more of it in that 12% that we're looking at, and then doing it with more the Roth or something like that. Maybe revisiting what you might have been doing in the past might have changed enough to make it better to pay taxes today, which normally we try to defer taxes, hoping they'll be lower when we hit retirement. Don't know if that's going to be the case.
Well, and that is a great point. One of the things when Friday and I work with clients, it's been great working over these years is that we recognize these trade-offs. Okay, we recognize we want to minimize taxes in the current year as much as we can, but we also take a longer view. So when we're taking that longer view, and this is one of the things, how many times do you have your taxes done and maybe your accountant says, you know what, we need to put a lot more money into tax deferred as an example, into an IRA. Because all they're thinking of is how can I reduce this tax this year?
Right.
Okay. When we're taking that longer view, we're saying, well, guess what? If I keep pumping money into that deferred plan, at some point I'm going to have to take it out. What's my income tax going to be at that point?
Exactly.
Is it going to be higher or lower than what it currently is? Doing an analysis of that is part of the comprehensive planning we do in my office, and Friday's a big part. When we work together with clients, which is quite often, this is one of the areas I'll do. I'll say, hey, can you run this tax return for me? I want to see the effect if we did this way instead of the way they're currently going. And we'll find out in advance before we implement a strategy what the tax implications are going to be. And in particular, where this comes in, it's not just the taxes, right? On that specific, let's say, to the IRA distribution. But we also have to look at the impact it's going to have on Social Security income. Is it going to cause it to become taxable or more of it? So we have thresholds there we can talk about as well.
Medicare as well, because it's means tested, right? So if your income is lower, you're going to pay less on your Medicare than if you have to have a higher income because you have to take higher RMDs or distributions due to keeping your lifestyle at a certain level. You may be able to, so knowing in advance if some of it was put into a Roth and paid taxes today, plain, like he always has these little buckets he likes to use, but having those all designed properly would be a way of controlling those taxes as well.
That's it. Because do you contribute to a Roth IRA, for instance, or a traditional IRA? A Roth 401k, if you have that option, or traditional. For those with TSPs, thrift savings plan, you have that option. Now here's, keep in mind, you got to look at all the different rules there. So you can't say, oh, I'm going to be better. I'm just going to put all my money into a Roth 401k. In particular with a TSP, be very careful with this because you don't get the matching on the Roth part. You can get it on the traditional contributions, so you need to make sure that first 5%, let's say on the federal plan, that first 5% is going in to get the match. Then with excess dollars you can feed into the Roth. The other part is looking at the tax implications. So for instance, if you're, let's say, a married couple, earning over 100,000 and you can make, let's say 110, you want to make contributions of 10,000 into that traditional, because that's taxed at 22%, all right? To reduce that down to anything under that's taxed only at 12%, there you might look at the Roth piece. Part of an analysis of financial, and doing this comprehensive financial planning that we talk about and that I offer up this week, one of the things that you get with that is that type of analysis as well. We look at the tax efficiencies in your investing and in your overall plan. So, you know, including contributions to which kind of, you know, IRA or 401k or TSP or whatever plan you have.
This next few years, it's really important to really look at this the next 5-7 years, because we have a 10% jump between 12 and 22. So every dollar you can defer and pay less, I think, would give you almost a 10% growth on that dollar. If you're in the 22 and it gets you down to the 12, or you're not paying tax, that's almost an instant gratification, which we all like when we're saving things.
Oh, huge. So, almost cutting really, in half your tax. Yeah,
exactly. So it's, I mean, especially for people that are very close, maybe you usually contribute 10, 15,000, and maybe you have been a little bit lazy on it because you really haven't noticed a huge change. I think it really, in the 18 through 26 or 25, you're going to want to do that. So you're going to really want to revisit that.
This is the year, 2018 is the year for the implementation of the Tax Cuts and Jobs Act, and this is where we were going to cover tax changes for you, some things still that you can do, important things to be aware of that you can still do between now and the end of the year that could help you with regard to your taxes for 2018. And we're going to talk more about some of the implications, or some of the implications of the Tax Act, and some things there that how it's going to affect you in the future potentially. Now, one other thing I want to cover, and I want to that I talked about at the beginning, was that of the markets and the portfolio, and this in particular, with the markets being as volatile as they are right now, it's another time to look at your investing from a tax standpoint. So is this a time, if you've got capital gains build up in your portfolios as an example, keeping in mind this, so we don't want to pay tax, okay, if we can avoid it, but it's understanding how this tax law works as well. So for instance, if you're again, that married couple, if your income, including any capital gain, is under 100, you got zero tax on that capital gain,
exactly,
right?
I love it, yeah.
Zero taxes. So it's not necessarily, you know, looking at the portfolio and seeing maybe there's some things that I might want to sell and reposition. This would be an excellent time to take a look at that, especially now at the end of the year where we got a pretty good view of what your income's going to be for the year, and see if that would work. And here's something to keep in mind as well. Even if you cross over, let's say with that gain, it's going to be over 100,000 and you're paying 20, you know, you're in a 22% bracket. Well, the capital gains rate is still only 15%. Yep, so you're still going to be protected there in terms of reduction in that tax. And here's the other piece then. Let's say, if in particular, if you have an asset, okay, a particular stock, or even a mutual fund that has a lot of gains in it, and the concern is what happens in a bear market. If we determine in an analysis, we look and it's got a high standard deviation, in other words a high volatility index that's going to indicate a large drop in a bear market. Well, if you've got, as an example, you got $1 million, well, let's say in a gain, we'll say that's $200,000 gain. On a $200,000 gain, if you have a 20%, or in the last two bear markets, it would have been 40–50% drop. Okay, if you've got that kind of volatility, and we're talking about you could change that and pay maybe a 15% tax on that gain, you're still coming out way ahead. That's in other words, if you had a loss of 20% in the market, that's going to be a lot more painful. You're going to lose a lot more than what that tax would have cost you, and guess what? You still have a tax. So it's a time at least to do an analysis and see what makes the most sense with regard to that. And you don't have to sell the whole thing. You might be starting saying, okay, right now we seem okay, in particular towards the end of the year, right? We could sell some now for this tax year and some next year for that tax year, and there's a way that we can, again, maybe either eliminate or greatly reduce taxes. So some of the things on this investment piece, I'm going to do one more thing. I got a couple of slides I want to share with you on the S&P 500 index, just to give some perspective with regard to the market. So if we have that one, there we go. So this is showing a balanced growth portfolio, model portfolio, using the Nobel Prize winning research I mentioned to you. In fact, this is Dr. Eugene Fama with DFA funds, and he won a Nobel Prize, by the way, in 2013 in economics for his equity research and developing what's known as the three-factor model when it comes to asset allocation. So you can Google these things and look it up, or you can come in and see me and I'll give you some additional background on that. That model portfolio that we're talking about, based on Dr. Fama's research, you can see how it did over the bear market. So when we're looking at the bear market, for instance, in 2000 through 2002, when the market dropped about 45%, the balanced portfolio was basically at about a break even over that point, just a bare loss on $1 million. Now, it's where the other lost 45%, $1 million turned into 550. Ouch. So then we go to 2008, and we see that now this one is the balanced growth. On the balanced growth, it lost, I believe it's around 20% on that year, compared to almost 40% in the market. So again, fared much better. And here's the other piece. If you notice, it recovered in 2 years, where it took the market 5 or more years to recover from both of those bear markets. This is another important piece when it comes to sequence of returns. But here's something else I want you to be aware of. When you look on the left there of your screen, the S&P 500 index, that, by the way, is, you'll see the ticker. This is the returns on a Vanguard S&P 500 index fund. And we can see how it fared, how the market fared over that period. Now take a look. The longest bull market, starting in 2009, we had a 25% increase, right? Huge year. Of course, we had some pretty big loss, so you expect that. But look at 2011. Less than 1% return that year. So it was a terrible year. In particular, preceding, we had 2 double-digit years. Then after, we had 3 double-digit years, huge returns, adding up to about almost 60% over those 3 years, and then again a flat year, 1/4%, right? So that's going to happen. I put that in the context of this year. And then we had in 2016 almost 11%, again last year about a 20%. Now this year we've been a tremendous amount of volatility, and basically year to date we're looking at somewhere between a -1 to a +1 in the markets, depending on whether you're looking at the S&P and the Dow, and for that matter the way it's been this past week, depending on what day even that you're looking at it as far as that range. So it's all those big drops, and then they, keeping that in mind. And here's something else. I have people coming in that are saying, wow, the market, they're thinking the market's done great because of course in 2016 and 17 it did great, and they're missing out, wondering what's going on with the market this year. Okay, and of course there's a lot of different factors that have been talked about, trade wars and interest rate increases, and all of these play into it, of course. But we still have a very strong economy, and when we're looking forward, we do have concerns about the Fed being too aggressive. We need them to raise rates, but hopefully they're going to do that in a balanced way to where we don't create a problem where there's not one right now. The economy's strong enough to absorb these, but we don't want to get too carried away and create a dampening effect on the economy at the same time. So hopefully the Fed acts responsibly on that one. One of the things for you to keep in mind is this. When it comes to this, is one, keeping perspective. So that's the point of, yes, the market is going through a lot of volatility, but net, it's not like 2 bear markets have been, where we've had huge losses. Okay, NASDAQ entered in correction territory, over 10% loss. Again, these things, just take a look at your asset allocation. This is a great time to do an analysis of your investment portfolio. It's a great time to see how you're positioned for a bear market, because this is the kind of time that we kind of gets our attention, right? We're saying, maybe I need to take another look. Well, I agree. I think it's definitely a good time to take another look. All right, we're going to get into some tax tips and some more about how that also can be used. Tax efficiency in investing is another part of this analysis. Great time to look at that as well. But first, we're going to take a break. So join us here. We'll be right back on the Retirement Report.